Following the early 2000s recession, the Fed dropped interest rates all the way down to a historic low of 1%, which meant borrowing was again easier to stimulate the economy, so it began to grow. Or did it? In 2004, the Securities and Exchange Commission suspended the net capital rule for Goldman Sachs, Merrill Lynch, Lehman Brothers, Bear Stearns, and Morgan Stanley, enabling them to take on debts with ratios of up to 20 to 40 to 1. So, with no limits on the amount of money created from nothing, which is effectively what credit represents. Wait, what? That's right. Even astute bankers like JP Morgan himself have long known that only gold is money and everything else is credit. So, with no limits on the amount of money created from nothing, these firms were $4.1 trillion in debt by 2007, at a time when the total amount of money to go around in the economy was only $1.4 trillion. How could that happen? These institutions were part of the shadow banking system that were not subject to normal banking regulations. So without regulatory oversight, they were able to package predatory loans called subprime mortgages into risky investment vehicles like mortgage-backed securities and collateralized debt obligations. So when investors realized that these loans belonged to people who couldn't possibly pay them back, they pulled their money, and this essentially led to a bank run on the shadow banking system, acting as a major catalyst for the '08 financial crisis, which saw a drop of 52% in the Dow Jones Industrial Average within a couple of years. The damage done here cannot be understated, because more than 8 million jobs were lost and 8 million homes were foreclosed. Retirement accounts fell by nearly $3 trillion. The net worth of households essentially vaporized by $17 trillion. Home prices plummeted by 32%, and GDP fell by nearly 5%. So no, this was not growth, as it was driven by debt, and the implosion drove the crisis. And again, we confront the same anomaly here, that despite increasing interest rates, the housing bubble formed and popped. How was this crisis handled? The usual drop in interest rates to increase borrowing commenced, but this time to nearly 0%. Worried that this wouldn't be enough to prevent a deflationary spiral, the Fed decided to expand their balance sheet by electronically creating money out of thin air for the bailout, also known as quantitative easing, because increasing money supply leads to spending in this paradigm. As this chart shows, this increased the money in circulation by nearly threefold since 2009. Given what we've seen so far, does this represent real growth? Actually, it's much worse than it looks.